In our last lesson, we had learned about different components of cost structure, that is, fixed cost, variable cost, and mixed cost. In this chapter, let us understand how different proportion of fixed and variable cost in a company's cost structure impacts its operating profit in different scenarios. Hey Tim, right now our sales and profits are increasing, but how much cushion do we have to survive downturns? Sir, that depends on the degree of operating leverage. Let me explain to you how. Margin of safety. Calculation of margin of safety is done as total actual or budgeted sales minus the break-even sales. So it is basically the difference between the break-even sales level and the actual sales that we are looking at right now. It can also be computed in percentage as margin of safety value divided by total actual or budgeted sales. Understanding this using an illustration of ABC Corporation, sales volume 400, sales value of $100,000 less the variable cost of 60,000 gives contribution of 40,000, fixed cost 35,000, so net operating profit comes to 5,000. Break even point in case of company ABC comes to 350 units, which is 35,000 divided by contribution per unit. Break even point in terms of value comes to 350 units multiplied by 250 as the selling price, that is $87,500. Margin of safety, therefore, for company ABC is $100,000, which is the current sales minus the break-even sales of $87,500, that is $12,500. Percentage of margin of safety is 12.5%, that is $12,500 of margin of safety value divided by the sales, that is $100,000. So how do you interpret these numbers of $12,500 or 12.5% of margin of safety? So it means that with cost structure remaining the same, reduction in sales by 12,500 or 12.5% would result in just breaking even. Higher the margin of safety for a company, more cushion a company has. Let's understand how different composition of cost structure, that is the different ratio of fixed and variable cost in different companies, impacts its profitability. Comparing two companies in the same industry, company A and company B, having same sales level of $100,000, variable costs are different, 60%, 30%. Contribution therefore is different for the two companies. Company A is lesser at 40% and company B is higher at 70% contribution. Fixed costs are different, 30,000. Company A has lesser fixed cost compared to company B, and company B is, as you see, double of that of company A. So net operating income of company A is 10,000, 10%, and company B is also at 10%. How is that possible? Because sales and the total cost of both the companies are not different. They are the same here in this case. So therefore, we see that net operating income of company A and B are the same at 10%, as both sales and total costs are the same. But what we also observe here is that contribution margin of company B is higher. So is company B at a relatively better position compared to company A? Let's take a look at different market scenarios. Assuming there is an upswing in the market, there is good demand, so therefore sales of both the companies jump up by 10%. So $100,000 of sales becomes $110,000 in both case of company A and B. Variable cost percentage 60 and 30% and contribution percentage 40 and 70 remain the same. Fixed expense in terms of total value $30 and $60,000 remains the same. So net operating income of company A is 13%, company B is 15%. What is the difference between net operating income of company A and B? It is 2%. So we see that company B, with a 10% increase in sale, company B is at a better operating margin compared to company A by 2%. What happens, let's say, if there is a downswing, lower demand, so therefore lesser revenue, sales drop by 20%. So $100,000 of sales turns to $80,000 now. Variable cost percentage and contribution percentages remain the same again. Fixed expense in terms of absolute values also remain the same. Net operating income in such a scenario of company A is 3% at $2,000, but company B gets into losses of 5%. So what is the difference between now the net operating income of company A and B? it is 8% of difference, that is 3 and minus 5. So in case of downswing, we see that company B is worse off compared to company A. So what does this mean? Which means that company with higher proportion of fixed cost has better mileage in case of upswing, but it runs bigger risk in case of downswings. So therefore, higher the ratio of fixed cost and cost structure, higher returns, but higher risk. Another way of understanding the concept, another metric to look at is operating leverage. How do you define operating leverage? It is a measure of how sensitive net operating income of a company is to a given percentage change in sales. A high degree of operating leverage means that a small percentage change in sales can produce much larger percentage increase in operating income. So if there is an increase in sales, let's say by 10%, it may lead to a change of operating income by more than 10%, could be 15, 20 different percentages at different level of sales. So operating leverage calculation is contribution margin divided by the net operating income. Let's understand by looking at an example here. Company A and B, same organization at same 100,000 level of sales, net operating income of 10%. Now what are the different operating leverages here? Earlier we had seen margin of safety numbers in case of this scenario. Let's understand operating leverage. 40,000 in case of company A, it is 40,000 divided by 10,000. That is 4 times. That is, it means that a 10% increase in sales will lead to a 40% increase in net operating income of company A. What is this in case of company B? It is 7. That is, 10% increase in sales will lead to 70% increase in net operating in case of company B. Company having the same total cost and sales have different operating leverages. One with higher proportion of fixed cost in its cost structure will have higher operating leverage. That is, operating income will be more sensitive to change in sales both ways, up as well as down. Now this operating leverage, does it for an organization remain the same throughout? Actually no. Let's take a look at different sales scenarios. Sales at 75,000 of company A, let's say, increase to 225,000. We are having the same contribution margin percentages and fixed expenses of 30,000 remain constant. Net operating income is 0 in case of sales of 75,000, which means the $75,000 of sales is the break-even point. And as and when we keep increasing our sales up to 225,000, we see that operating leverage, it starts declining from 16 all the way down to 1.5. So what does this mean? Operating leverage is highest close to the break-even sales, and it keeps declining with increasing sales. Taking a look at a case study of an e-com company, let's take a look at different results that the company had in case of 2 quarters, one in previous financial year, one in current year. Sales of this company doubled from 58 to 116 million, and its net operating income increased from 17.6 to 5 loss of 17.6 to 5.7 million. So there we see that there is a change of 100% and net operating income has changed by 132%. So therefore, with negligible variable cost, degree of operating leverage is high. Flip side of high operating leverage, as we have already discussed, is if sales plummet, profits will nosedive.